The golden age of Canadian real estate has officially ended, and for thousands of property owners in 2026, the dream of passive income has transformed into a financial death trap. Welcome to a deep dive into the most volatile housing market we have seen in decades. As we move through the first half of 2026, the landscape for Canadian landlords has shifted from a position of power to one of extreme vulnerability. We are currently standing at the intersection of three devastating economic forces. First, the massive 2021 mortgage renewal cliff has finally arrived, forcing investors to renew their debt at rates that are double or triple what they were 5 years ago. Second, we are seeing the results of record-breaking housing completions from the 2023 construction boom finally hitting the market, leading to an oversupply in key urban centers. Third, provincial governments have tightened rent caps to historic lows to combat the cost of living crisis, leaving landlords unable to pass on their rising costs to tenants. This is no longer about a correction, it is about survival. Today, we are analyzing the top 10 cities where the math simply does not work anymore and where landlords are losing everything. Starting at number 10, we look at Sudbury, Ontario. For a long time, Sudbury was the hidden gem for Southern Ontario investors looking for lower entry point and high yields. However, 2026 has brought a harsh reality check. The primary problem here is the demographic shift. The surge of transient workers and international students that fueled the 2022 rental boom has slowed significantly due to federal policy changes. Landlords who bought aging housing stock with the intention of doing minimal renovations are now facing a surplus of vacant units because the industrial sector has plateaued. There isn't enough high-income growth to support the rent increases needed to cover the new 2026 mortgage rates. Investors are finding themselves stuck with properties that require massive capital expenditures like roof replacements and book upgrades at the exact same time their monthly mortgage payments have jumped by 30%. In Sudbury, the cheap investment has become a bottomless money pit. Moving to number 9, we find Winnipeg, Manitoba. Winnipeg has traditionally been known as a stable, slow and steady market, but in 2026, the city is suffering from a massive supply-demand inversion. Over the last 3 years, developers flooded the market with multi-family apartment complexes and townhomes. Now, those thousands of units are coming online all at once. For the individual mom and pop landlord, this is catastrophic. They are now forced to compete with massive corporate REITs that are offering incentives like 3 months of free rent and waive security. A private landlord holding 1 or 2 condos cannot afford to offer these perks while paying 2026 interest rates. As a result, vacancy rates in Winnipeg's suburban rings have spiked to levels not seen in 15 years, leaving private owners with empty units and no way to cover the carrying costs. At number 8 is Regina, Saskatchewan. The crisis in Regina is centered around the total stagnation of equity. While other parts of Canada saw massive price appreciation between 2021 and 2024, Regina remained relatively flat. In 2026, this lack of growth has become a terminal issue for investors. Many landlords here used high-ratio financing to enter the market, expecting that even if cash flow was thin, equity would grow. Instead, property values in many Regina neighborhoods have actually dipped by 4 to 6% over the last 18 months. Landlords are now underwater, meaning they owe the bank more than the property is worth when they go to renew their mortgages this year. They are being asked to put more cash down just to keep the loan, but that cash has already been evaporated by inflation. Regina is a market where landlords are walking away because there is simply no light at the end of the tunnel. Number 7 brings us to Saskatoon, Saskatchewan. Saskatoon's problem in 2026 is the cooling of the resource-driven rental market. The city saw an incredible influx of capital during the potash and uranium boom of the early 2020s. Investors rushed in to buy luxury rental units, banking on high-income professionals to fill them. However, as global commodity prices stabilized and the local sector reached its employment peak, the high-end rental market collapse, we are now seeing a massive oversupply of premium rentals with almost no one to rent them. Landlords are being forced to slash rents by 20% just to attract a tenant, but those lower rents don't even cover the interest on their loans, let alone the property taxes and insurance, which have both increased significantly in 2026. The luxury gamble in Saskatoon has failed, leaving investors holding high-interest debt on assets that the local market can no longer support. Coming in at number 6 is Halifax, Nova Scotia. Halifax was the poster child for the pandemic-era migration boom, but in 2026, the Halifax hype has officially evaporated. The problem here is the reversal of the work-from-home trend and the sudden stabilization of the population between 2020 and 2024. Rents in Halifax grew faster than almost anywhere in Canada. Landlords bought in at record high prices, assuming those rent increases would continue forever. However, the Nova Scotia government's decision to maintain strict rent caps in 2025 and 2026 has trapped these owners, while their property taxes, heating oil costs, and mortgage interest have soared. Their ability to raise rent is restricted to a fraction of that increase. Landlords who bought in 2021 and 2020 are now realizing they are losing $500 to $800 every single month, and with the migration gold rush over, there is no one left to sell the property to at a profit. Number 5 is London, Ontario. Investors from the Greater Toronto area use London as a playground for buying distressed properties, renovating them, and refinancing them to pull out cash. In 2026, that strategy has become a trap because interest rates have remained higher for longer than anyone predicted. The refinance portion of the strategy is now impossible. Many landlords in London are holding private short-term bridge loans that they can no longer transition into traditional mortgages. This has led to a spike in power of sale listings across the city. Small-scale investors are losing their portfolios because they banked on rates dropping back to 2%. London's rental market is also being hit by the contraction of the international student sector, which has left. Moving to number 4, we have Calgary, Alberta. Calgary was the last bastion of hope for Canadian investors in 2023 and 2024. The Alberta is calling campaign work too well, leading to an unprecedented construction frenzy. Now, in 2026, Calgary is facing the supply trap. More units were completed in the last 12 months than in the previous 3 years combined. This has caused a sudden and sharp drop in rental prices. Landlords who fled the Ontario and BC markets to find freedom in Alberta are finding that they jumped out of the frying pan and into the fire. While Alberta lacks the strict rent controls of Ontario, the sheer volume of competing units has forced a market-driven rent reduction. Landlords who bought at the peak of the 2024 Calgary craze are seeing their cash flow turn negative as they struggle to compete with a surplus of new-build condos that offer better amenities for lower prices. At number 3 is Kelowna, British Columbia. The situation in Kelowna, the perfect example of how legislative changes and destroy an investment overnight. The 2026 landscape in Kelowna is defined by the total gutting of the short-term rental market and the introduction of aggressive new provincial taxes. Landlords who bought high-priced condos expecting to make a fortune on Airbnb have been forced to convert those units into long-term rentals. This sudden flood of long-term supply has caused rents to plummet across the Okanagan Valley. BC's speculation and vacancy taxes have made it incredibly expensive to hold these properties. They aren't occupied by a long-term tenant. Kelowna landlords are facing a tax squeeze that, combined with 2026's high strata fees and insurance premiums, makes owning rental property a losing proposition. Most are not trying to sell. With so many investors exiting at once, prices have cratered. Number 2 is Vancouver, British Columbia. In 2026, Vancouver has become the most mathematically impossible city in the world for a landlord. The disconnect between property prices and rental income has reached a breaking point. To break even on a median-priced condo in Vancouver today, a landlord would need to charge a rent that is nearly double what the average local family earns. Because of the provincial rent cap of just over 2%, landlords who have had tenants in place since 2021 are effectively subsidizing their tenants' lives. As these landlords hit their 5-year mortgage renewals in 2026, their monthly payments are jumping by $2,000 or more. There is no way to bridge that gap. We are seeing a mass exodus of individual landlords from the Vancouver market, often selling at a massive loss just to escape the monthly negative cash flow that is draining their retirement savings. Finally, at number 1, we have Toronto, Ontario. Toronto is the ground zero of the 2026 landlord apocalypse. The city is currently facing what economists are calling the Great Condo Glut. Thousands of units that were sold to investors as pre-construction in 2020 and 2021 are finally being delivered, but the investors can't afford to close on them. Those who did close are facing a mortgage bloodbath. Over 60% of Toronto's condo investors are currently in a negative cash flow position, losing an average of $1,500 every month. The resale market has been paralyzed because no one wants to buy an asset that loses money, and the rental market is saturated with new completions. Toronto is where the 2021 renewal cliff is hitting the hardest, and for many landlords, the only way out is a power of sale or a bankruptcy filing. It is a market defined by high debt, low yields, and a total lack of liquidity. In conclusion, the Canadian rental market in 2026 is a sobering reminder that real estate is not a one-way street to wealth. The combination of high interest rates, aggressive supply increases, and government intervention has created a new normal where the risks often outweigh the rewards. For landlords in these 10 cities, if you like this video, kindly click the like button, share it with others, and subscribe to our channel.